Most people never notice this happening. That's why it works. It doesn't look like a fee, it doesn't look like a mistake, and it's never presented as a choice that could cost you tens of thousands over time. In fact, it's usually presented as a safe option. People over 60 are especially vulnerable to it, not because they are careless, but because they are trying to do the right thing. They are trying to reduce risk. They are trying to simplify. They are trying to be responsible. And the system quietly rewards that mindset in a way that looks helpful in the short term, but expensive in the long run. I've seen this pattern repeatedly. It rarely shows up immediately. It shows up slowly over years, disguised as stability. The reason most people don't catch it is simple. They are not told what they are trading away. When banks talk about safety, they usually mean one thing. When customers hear safety, they hear something else. That gap is where the cost appears. Let's start with what the safe option usually looks like. At some point, often in the late 50s or early 60s, people are encouraged to reduce complexity. Lower payments, predictable costs, fewer moving parts. This often comes in the form of refinancing, restructuring, or adjusting how debt is carried. The language is calm, reassuring, responsible. Lower monthly payments feel like relief. They feel like control. They feel like progress. But there is a hidden trade being made. What looks like safety on the surface often extends the life of debt quietly into years, where flexibility matters more than efficiency. The trick is not malicious, it is structural. Banks optimize for predictability of cash flow. Customers optimize for peace of mind. Those two goals are not the same. When payments are lowered, something else usually increases. Time. Time is rarely framed as a cost, but it is one of the most expensive variables in finance. Extending time increases total interest paid. That part is obvious, even if people underestimate it. What is less obvious is how time interacts with age. At 35, time works for you. At 60, time starts working against optionality. The system does not adjust its incentives when you cross that line. It keeps applying the same logic. That is where the quiet cost appears. Imagine two scenarios. In the first, someone prioritizes finishing debt earlier, even if monthly payments are higher. The structure is tighter now, but simpler later. In the second, someone prioritizes comfort now, accepting lower payments spread over a longer period. On paper, both look reasonable. In practice, they lead to very different outcomes after 60. The second scenario often results in debt still being present at a stage of life where income is less flexible and decisions are harder to reverse. That lingering debt interacts with inflation, health costs, and reduced earning power. None of these appear in the initial conversation. The conversation focuses on monthly affordability, not lifetime cost, not strategic timing. Banks are very good at framing questions narrowly. Can you afford this payment? Is a very different question from, should this obligation exist at this stage of your life? The system rarely asks the second question, and many people don't think to ask it themselves. This is where the $20,000 often hides, not as a single charge, not as a visible loss, but as accumulated interest paid during years when money could have been doing something else, or more importantly, when money was needed for something else. Another part of the trick involves predictability. Fixed rates, fixed payments, long horizons. Predictability feels like safety, especially when people are approaching retirement or already retired. But predictability without flexibility is not safety. It is rigidity. Rigid structures perform well only if life behaves as expected. Life rarely does. Health expenses don't arrive on schedule. Family needs don't wait for financial plans. Markets don't respect timelines. When debt is extended into later life, it competes with these realities. And because the payments feel manageable, people don't feel urgency. They drift. Years pass. Interest accumulates quietly. The cost does not feel like a loss because it is spread thinly across time. But when you add it up, the number is often shocking. This is why people are surprised later. They look back and realize how much they paid for comfort. And at that point, the structure is harder to change. Refinancing options narrow with age. Income verification becomes stricter. Risk tolerance on the bank's side decreases. What once felt flexible becomes fixed. This is the part no one explains clearly. The bank's idea of safe is not aligned with your long-term leverage. Banks want stable, predictable inflows. They are rewarded for extending relationships, not shortening them. A longer loan is not a problem for the system. It is often preferable. For the individual, especially after 60, it can quietly erode options. This is why the trick works so well. It is not sold as a trick. It is sold as help. And it only becomes visible when time has already done its work. There is also a psychological layer to this. Lower payments reduce stress. Reduced stress feels like progress. People stop thinking strategically when stress decreases. They stop questioning the structure. This is not a flaw, it is human. But the system benefits from it. Once the pressure is gone, inertia takes over. The loan continues. The interest continues. The cost accumulates quietly. And because nothing dramatic happens, there is no moment that feels wrong. That is why so many people discover this too late. They don't fail financially. They drift into a structure that slowly extracts value when flexibility matters most. The most dangerous financial costs are the ones that feel harmless, and this is one of them. To understand why this cost is so persistent, you have to look at incentives. Banks are not rewarded for helping you finish obligations earlier. They are rewarded for stability and duration. Longer relationships mean more predictable income. Predictable income reduces uncertainty for the system. When someone accepts a longer loan with lower payments, the bank has achieved exactly what it wants. A steady stream of cash that is unlikely to be interrupted. From the customer's point of view, the focus is usually narrower. Lower payments mean easier months. Easier months feel safer. Both sides believe they are making a good decision, but they are optimizing for different outcomes. This difference becomes expensive when time is no longer abundant. In earlier life stages, extending time often makes sense. Income can grow, opportunities expand, mistakes can be corrected. After 60, those assumptions weaken. Income is often fixed or semi-fixed. New borrowing becomes harder. Recovering from structural mistakes takes longer. Time stops being a neutral variable and starts becoming a constraint. This is why extending debt into later life carries a hidden premium. It limits how you respond to change. When health costs rise, debt reduces flexibility. When markets fall, debt reduces options. When family needs arise, debt narrows choices. None of these appear in the monthly payment calculation. They appear in the background, shaping what is possible and what is not. This is also where the $20,000 figure becomes realistic, not hypothetical. Extended loans accumulate interest during years when money could otherwise be strengthening buffers, reducing exposure, increasing freedom of choice. Instead, that money flows out quietly, month after month. People often say, but the payment is small. That is exactly why it works. Small costs feel harmless. Repeated costs become significant. Another part of the trick is timing. Banks often suggest these structures at moments when people are already tired of financial complexity. After decades of managing loans, payments, and uncertainty, simplicity is attractive. A lower payment feels like relief. It feels like progress toward calm. The problem is that calm achieved by extension is fragile. It depends on life behaving predictably for a long time. That is not a safe assumption. True safety in later life comes from reducing obligations, not stretching them, from shortening timelines, not extending them, from having fewer commitments competing for fixed income. This does not mean all debt is bad. It means debt that outlives flexibility is expensive in ways people underestimate. There is also a behavioral trap involved. Once people accept a lower payment, they often stop allocating extra money toward the loan. They treat the new structure as the final one. This is where inertia locks in the cost. Years go by, the balance declines slowly. The interest continues. The system does not remind you of what you are paying in total. It only shows you the monthly number. Visibility matters. What is visible feels manageable. What is invisible is ignored. Banks are excellent at presenting information in ways that emphasize affordability over cost. This is not deception, it is framing. But framing shapes behavior. If people saw a running total of interest paid after 60, decisions would look very different. Most do not. There is also a subtle status effect. Being approved for a restructure or refinance feels like validation. It feels like the system is cooperating. People interpret that cooperation as confirmation that the decision is good. They rarely ask whether the cooperation serves the same long-term interests. Over time, the cost accumulates. It rarely feels dramatic enough to trigger action until flexibility is needed. That is when the structure reveals itself. The most painful moment is not the realization of cost. It is the realization of lost options. At that point, the $20,000 is already gone. The lesson here is not to reject every offer that lowers payments. It is to understand what is being exchanged. Lower pressure today often means longer obligation tomorrow. That trade can be reasonable, but it should be deliberate. The key question is not, does this feel safer now? It is, what does this do to my freedom later? Freedom later is worth more than comfort now, especially after 60. The people who avoid this cost tend to think differently. They look at time as a strategic resource. They resist extending obligations into years where adjustment is harder. They value boring progress over immediate relief. They accept short-term discomfort in exchange for long-term simplicity. This is not about discipline or virtue. It is about alignment. Aligning financial structures with the realities of aging, not the assumptions of earlier life. The bank system does not make that adjustment for you. It applies the same logic at every age. Understanding that is critical. The trick works because it feels helpful, because it reduces stress, because it looks responsible. But responsibility is not about minimizing monthly discomfort. It is about preserving flexibility over time. Once you see this clearly, the decision becomes easier. You stop asking how small the payment can be. You start asking how soon the obligation can end. That single shift protects far more than $20,000. It protects options. And options are the real currency later in life. That is the part the system never explains. But once you understand it, you can no longer unsee it. If this changed how you think about safe financial choices, pause before your next decision. Comfort today often hides costs tomorrow. In future videos, I'll continue breaking down these quiet trade-offs, calmly, clearly, and without sales or noise, so you can protect flexibility when it matters most.